Welcome to Volatility Trading Strategies. So one of the most overlooked aspects of successful long-term investing, in my opinion, is investor psychology. So many traders out there focus on the markets, the signals, technical and fundamental analysis, all the quantitative aspects that go into a strategy, which are all very important. I'm not saying they aren't. But the truth is, you could have the best strategies in the world within your spreadsheets, but if you can't also navigate the emotions of the process, then it won't lead to the kind of results you're looking for. So today I'm going to talk about a very interesting, yet potentially financially costly aspect of investor psychology. It's an emotional bias that if you want to succeed in the long run, you have to avoid doing. Let me show you what it is. So the psychology I'm talking about here is the tendency for investors to feel more negative emotions towards not making as much money as the people around them than they do losing substantial amounts of money, but when other people around them are as well. Let me illustrate what I mean with a question. Which one of these two outcomes do you think people in general should feel more negatively about? Is it A, losing 20% of their capital, but knowing that the benchmark index and most other investors as well also lost 20% of their capital? Or B, earning a positive 5% rate of return, but knowing that the index and most other investors made 10% or more? I'm sure you've experienced both in your life, so which one gave you the more negative feelings? The surprising thing is, most people actually feel more negatively towards B, which is to say, the thing that investors tend to hate the most is making a smaller rate of return than the index and the people around them, even if that rate of return is still positive. And this is strange because it's clearly the wrong answer, right? Obviously, it's more beneficial to be making the positive return, even if it does mean that it's a little lower than the people around them. Yet studies often show people are relatively okay with losing money as long as they know that the other people around them are as well. For some reason, people tend to feel more comfortable following the crowd, even if that crowd is losing money. We saw a great example of this psychological bias recently, when the S&P 500 crashed 20% in the fourth quarter of 2018. Obviously, nobody likes to lose money, that's not what I'm saying. But investors do find a bizarre level of comfort in taking those losses, knowing that most of the people around them are in the same boat. But it's been a decent recovery so far. And this is where the true negative emotions are felt. Because people who perhaps made a little money during the recovery, but they look at the index and maybe other people around them who are making more than them, and they feel left behind. They feel they're underperforming and it really bothers them. Losing 20% when the index also loses 20%? Well, they're not happy, but they're relatively okay with it because it makes sense. They think, of course I'm down, the markets are crashing, the index itself is way down, of course I am too. But only making 5% when the index maybe made 10 or 15%, people hate that feeling. Of course, it's not rational, we should look at the big picture, but it's just how they feel. But what matters most is, what does this feeling do to a long-term investor? What does this irrational psychological bias mean for how they structure their investments going forward? Well, for one thing, it makes them gravitate towards buy and hold investing, doesn't it? They know that they feel uncomfortable when they decouple from that index, so they tend to make decisions that remain closer to it. But why would people do this? We know, mathematically speaking, that buy and hold investing is a terrible idea, and it leads to very poor long-term performance. Inflation adjusted, it took the S&P 500 a full 15 years to recover from the peak in 2000. And believe it or not, inflation adjusted, the Nasdaq index is still down slightly from the highs. That is a very long time to have not made any gains. Imagine an investor who dramatically outperformed the index during that crash, meaning they lost very little. But they also underperformed the index on the recovery. In the long run, they'd be miles ahead in overall value. But this psychological bias I'm talking about would make most investors feel worse here, underperforming during the recovery, rather than there, where it mattered most, when they avoided most of the damage. Clearly, it's irrational, so you might be thinking, well sure, investors do tend to be irrational. That's why they go to professionals for guidance. But do you want to know what the worst part is? The biggest offenders of this psychological bias are professional managers. Believe me, they know better than anybody where the consequences of underperformance are the most severe. You'd be surprised, But losing a significant amount of investor capital during the fourth quarter of 2018, when the S&P 500 was also crashing, that doesn't really matter that much to professional fund managers because they know that most of the other managers at most of the other banks also did as well. Those losses are easy to explain away. Maybe they're on a call with a client or in a meeting with their boss, and they say, sure, we're down a lot, but so was the index. They'll say it's been a rough patch, but we'll stay the course and we'll do better when the markets recover. Done deal. Even though they are bleeding capital, most investors are strangely okay with that explanation and they don't leave. They just assume that there was no way to avoid it and nowhere else to go because of course everybody else is in the same boat. And the manager keeps his job as well, and it's business as usual. But do you want to know where managers truly feel vulnerable? If they didn't fully participate in the subsequent recovery. That's when they have some serious explaining to do, and that's when they might actually lose some clients. If a professional manager only lost 1/3 as much as the index during the crash, but only made 1/3 during the recovery, they'd be well ahead of buy and hold. That's mathematically true. Losses are always more costly than the gains are beneficial. So avoiding most of the drawdown was the more meaningful portion. But that decoupling from the index and the underperformance in January and February is far more problematic for them, and they know it. As bizarre as it sounds, their client retention would have been far safer had they just lost 20% in the fourth quarter of 2018 when markets were crashing, and then subsequently participated in the entire recovery. They'd still be negative, of course, and the client would be worse off, but they wouldn't technically be underperforming their benchmark, so it's all good. This irrational psychological bias I'm talking about today forces fund managers to be what's called closet indexers. This is where they claim to be active fund managers, but then they set up their portfolios to closely track the index. Even though they know the performance won't be very good in the long run, and that's proven by a mountain of evidence on the failures of buy and hold investing, but they find it easier to deal with clients when they don't decouple from the index. It's also why hedge fund correlation to the S&P 500 has been steadily rising over the last 20 years. In the late 90s, when hedge funds actually did adopt interesting and unique strategies, correlations to the S&P 500 were less than 50%. Today, it's up at 90% correlated, because they don't dare decouple from the index anymore. It's largely just a game of closet indexing at this point. And this has had a strong negative effect on client portfolios invested in them. Believe it or not, hedge funds actually used to perform quite well. When they weren't afraid to decouple from the index and they were implementing out-of-the-box investing techniques, many of them performed quite well and produced positive alpha. But no more. This closet indexing, largely out of fear of standing out, has taken care of that performance rather harshly, to the point where active managers these days, for the most part anyway, literally are index returns minus management fees. Guaranteed negative alpha built into the strategy. Well, what's the point of that? Believe me, with a little help from Google, you can easily manage that on your own without paying anyone any management fees. So this tendency for investors to feel worse about lagging the index in good times is basically the reason why most fund managers these days are closet indexers. They know the consequences for underperformance during good times is far more severe than the punishment for losing money during bad times. That's just how the financial industry is set up these days. The incentives are not geared towards long-term outperformance. Everything is right now, this quarter, this month. The what have you done for me lately kind of attitude. It's irrational and it's definitely worse for client portfolios, but it's just the way it is. So now that you understand this, what actually can be done about it? Well, let me give you 2 tips going forward. More specifically, 2 performance metrics that you may want to pay closer attention to that go far beyond just short-term rate of return. It's natural to try to catch every uptrend and maximize performance on the way up, but just don't let that come at the expense of taking excessive losses when things don't cooperate. Markets can crash 20, 30, sometimes 40% or more, so you definitely want to favor strategies that show manageable drawdowns. There was no reason to suffer major losses in the fourth quarter of 2018. The volatility metrics were screaming warning signs well ahead of time. But closet indexers, which unfortunately is the vast majority of investors these days, would have suffered most or all of it. So I have a video here discussing maximum drawdown that you may be interested in. It's one of the most overlooked metrics, but in my opinion, as important as anything to be kept to a reasonable level. So check out that video on reducing maximum drawdown. Second, not only is there nothing wrong with reducing correlations to the indexes, but it's actually very beneficial. We've already seen for over 2 decades now the consequences and the low performance when tracking the index. Many years, perhaps multiple decades of very low gains is possible when tracking those indexes. Just look at the S&P 500 and the Nasdaq over the last 20 years. So don't be afraid to decouple from what the crowd is doing and follow strategies that show lower correlation to the S&P 500. It used to work for hedge funds back in their heyday, and it can work for investors now if they have the courage. And it does take courage, because there will definitely be times when the index is moving up, and having that low correlation may mean underperforming for a short period of time. But in the long run, maintaining a lower correlation to equities is superior. Now, I also have a video specifically talking about reducing correlations to the S&P 500 here. Check that one out too if you have some time. Investors need to understand this concept to be successful. Cognitive and emotional biases like the one I'm talking about today really can be detrimental to our long-term investing future. But if we're aware of them and we understand when it's happening, we maximize our probability of success going forward. So if you want to know how I personally keep my drawdowns manageable, keep the correlation to the S&P 500 low, which has in turn allowed me to crush the markets for years, then go on over to my website, claim your free trial, and see what the VTS community is all about. We'd love to have you. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.